Something extraordinary just happened in the business world. In the third quarter of 2025, global mergers and acquisitions deals surpassed $1 trillion. That's right. In just 3 months, companies announced more than $1 trillion worth of takeovers, buyouts, and strategic mergers. This is one of the biggest surges in deal-making we've ever seen. But why is this happening now? What industries are driving it? And what does it mean for mid-sized firms and the giants of global business? Let's break it down. First, the scale. $1 trillion in M&A activity in 1 quarter isn't just a headline, it's a signal. It tells us that companies aren't just surviving the current economic uncertainty, they're making bold, aggressive moves to reshape their future. This isn't the slow, cautious deal-making we saw during the pandemic years. This is a wave of mega deals that signals confidence, or at least urgency, in reshaping industries. So what's driving this explosion? One factor is simple: cash. Big companies are sitting on enormous reserves of cash after years of strong profits. Even with interest rates higher than they were in the 2000s, these companies have the balance sheets to pull off multi-billion-dollar deals. Rather than letting that cash sit idle, they're using it to buy growth, technology, and market share. Another factor is competition. AI, clean energy, and digital transformation are creating massive shifts in every sector. Instead of building capabilities from scratch, companies are buying them. Think about it. If you're a traditional automaker struggling to catch up in electric vehicles, buying a battery startup is faster than building your own tech. If you're a bank trying to modernize, acquiring a fintech company might be the quickest way forward. In times of disruption, M&A becomes the fastest path to adaptation. There's also a defensive side to this. In a world of global uncertainty, from tariffs to supply chain risks to geopolitics, companies are consolidating to survive. Bigger firms have more leverage, more resources, and more insulation against shocks. In industries like pharmaceuticals, where patents expire and competition is fierce, merging or acquiring is often the only way to maintain an edge. Now let's talk about which industries are leading this surge. Technology is at the top of the list as giants race to secure their place in the AI and semiconductor revolutions. We've seen chip companies striking huge deals, software firms buying AI startups, and cloud providers expanding through acquisitions. Healthcare and pharmaceuticals are also hot, with major players buying biotech firms to fill their pipelines. Energy is another area, as oil and gas companies diversify into renewables and utilities invest in battery storage and grid tech. Even retail is seeing activity, with companies consolidating to fight off e-commerce disruption. For big firms, the meaning of this surge is clear. The race is on. Companies that sit on the sidelines risk being left behind as their competitors bulk up. For CEOs of global corporations, the fear isn't just missing out on growth. It's waking up to find that your biggest rival now controls the market because they acquired the one company that could have changed your future. For mid-sized firms, the implications are more complex. On one hand, it's an opportunity. If you're a growing company with valuable technology or market share, you may suddenly find yourself being courted by giants looking to acquire. That can mean massive payouts and access to resources you could never get on your own. On the other hand, it means you could be crushed if you're competing against newly merged behemoths. Consolidation raises the stakes, and smaller players will need to be nimble, specialized, and innovative to survive. Of course, not everyone sees this boom as purely positive. Regulators are already raising eyebrows. With consolidation comes the risk of monopolies, less competition, and higher prices for consumers. Antitrust scrutiny is increasing, particularly in the US and Europe, and some of these deals may never actually close. The bigger the wave of M&A, the more governments will feel pressure to step in. There's also the question of risk. Big mergers often look great on paper but fail in execution. Cultures clash, synergies don't materialize, and debt loads become unsustainable. If companies overpay in this frenzy, we could see a wave of write-downs and failed integrations down the line. History is full of mega mergers that promised the world but ended up destroying value instead of creating it. Still, the momentum right now is undeniable. Companies are looking at the landscape of 2025, high tariffs, global economic uncertainty, rapid technological change, and deciding that the best move is to get bigger, faster. The trillion-dollar milestone isn't just a financial story. It's a sign that corporate America and its global peers are gearing up for a new era of consolidation. So what does this mean going forward? Expect the deal wave to continue, especially in technology, healthcare, and energy. What do you think? Is this wave of mergers a sign of strength and adaptation? Or are we headed toward a consolidation bubble that could backfire? Let me know your thoughts in the comments below.